I think sovereign wealth funds, central banks are showing the way. And that's why JP Morgan talked about the $6,000 gold by 2029. It could be before 2029. So as you can see, during this century, like against stocks, gold is outperformed, versus treasuries as well. Yes, after 2011, there was a big consolidation, just like the gold price did in cash, up until basically the beginning of last year when it actually took off. And you can see here that it's continuing to go higher.
Central banks and major international investors are quietly speeding up their shift away from fiat currencies, especially the US dollar. Mario Innecco, a seasoned financial professional and former UK gold dealer, has made remarks that underscore the rising instability of the global monetary system. Gold and sound money are receiving more attention as debt levels soar and inflation stays high. According to Innecco, central banks are stuck since they can't cut without rekindling inflation or hike rates without causing defaults. He contends that central banks' increasing purchases of actual gold are a calculated move away from the dollar-based economy rather than a happenstance. Meanwhile, markets are beginning to break as international demand for treasuries declines and US bond yields rise. Mario thinks that maintaining international liquidity for debt denominated in dollars may be more important than trade in the current geopolitical arena, which includes US-China diplomacy. Additionally, as the notorious yen-carry trade winds down, he cautions about the impending threat posed by Japan's monetary tightening, which may trigger a wave of capital flight from US assets. Please remember to like this video, subscribe to the channel, and enable post notifications before we delve further. Thank you and enjoy the video.
So what I wanted to say is that, is this really a trade deal? Some people have noted that it should have been Trade Representative Navarro and also Commerce Secretary Lutnick that should have gone to Geneva if it was a trade deal. Could this be another kind of deal, maybe to do with having China support the US Treasury market? And I doubt they will do that. And as I speak here, and it's 6:35 a.m. London time, the 10-year yield is up 4 basis points at 4.42. Keep an eye on the 433 level. That's a really important level. And I've noticed that Japanese yields are not behaving very well. The 10-year yield is up substantially. It's almost at 140. Just show you this chart of the JGB 10-year yield. Yes, it took a big drop in the beginning of April and then rebounded. It looked like it was going to drop again. It looked like a bear flag. Which is positive for bonds, negative for yields. But now it's rebounding back again. It's broken this bear flag. And why is this important? Well, because of the yen carry trade. For decades, really, the Western financial markets have been financing their speculative liquidity activities by borrowing yen. But now, if Japanese government debt yield starts rising, Japanese investors, they're gonna come home and sell their treasuries and start investing in JGBs because there's a higher yield. Up until a couple of years ago, the yield on this 10-year was like 0, sometimes even negative. And there are a lot of hedge funds and speculators in the West who have been borrowing in yen to, take those proceeds into dollars, put it into dollars and buy high-yielding assets in the West. But as the cost of borrowing in yen rises, they're going to have to unwind those carry trades. And they're going to lose a lot of money. They're going to have to sell a lot of their assets. So keep an eye on that. So I think there's trouble ahead for the financial markets, again, stock markets and bond markets. And there's another reason for it. It's the fundamentals. I just saw there's an article or some kind of research that Morgan Stanley, it says Morgan Stanley reveals the ugly truth about the 2026 budget deficit. That's the other thing we need to focus on. I think there's $6 trillion to be rolled over in treasuries before the end of the fiscal year. Morgan Stanley talks about the fact that the deficit for 2026 fiscal year is going to be about 7% of GDP. It's already about 7% this fiscal 2025.
As more underlying information becomes available, Mario says, markets may experience another steep sell-off, particularly since a lot of the present confidence surrounding US Treasuries and trade agreements may be misplaced. Gold's rise as a more reliable and robust store of value is putting increasing pressure on the bond market, especially on long-term Treasuries. The US dollar will probably continue to decline as gold gets traction, and Treasuries depreciate in real terms. There is growing speculation that the Fed would be forced to intervene once more through quantitative easing or perhaps yield curve control measures, which would probably drive up gold prices even further and put additional pressure on the bond market. Uncertainty remains over the dollar's future, even in the event of new trade agreements, particularly given the potential for a shift in U.S. leadership. The dollar's position as the world's main reserve currency may be in jeopardy due to this uncertainty and increased prudence on the part of international investors. Don't forget to subscribe and hit the bell icon to stay updated on our latest videos. We'd love to hear your thoughts in the comments. Now let's dive back into the interview.
What do I think is going to happen? Well, I think when the details actually come out at 7 a.m. from Bessant, we'll see the markets sell off. And I personally think the markets are too optimistic, even though they haven't really risen that much. And it will be really interesting as well to hear what the Chinese have to say. I think that's important as well, what the Chinese have to say. Very important, actually, probably more important than what Bessant and Trump are saying. It seems like they're just trying to maneuver the markets. It just seems crazy that that's what's going on. So I said earlier that long-term treasuries are losing the war to gold. And yes, gold is down overnight quite substantially. We're down $53 right now at $32.71, 1.5%. Silver, though, is slightly higher, $32.83. I'm not concerned about gold, but let's look at this long-term chart of the price of gold in US 10-year notes. That's constant maturity 10-year note futures, or 10-year cash 10-year notes. What is constant maturity? Well, you always have to keep updating to the new 10-year, because when you issue a 10-year Treasury note, when the Treasury does issue, let's say in 2025, by 2027, it's not a 10-year note anymore, it's an 8-year note. So it has to be adjusted. So this is just like having the price of gold in 10-year notes instead of dollars. And dollars, don't forget, cash is really a debt security, but it's a spot treasury, right? If you think about it. So this isn't any different than cash. So it's not really surprising to me, but a lot of people don't look at these kinds of charts, and they still think that having bonds in your portfolio is a good thing. Or I'll give them a little bit of credit that it might be safe because the government will always pay you back. But I think that keeping 40% of your wealth in bonds doesn't really cut it in the current environment and for the future prospect of the system. I think I've seen someone talk about a new 40-20-20 portfolio, 40% stock, 20% bonds, 20% gold. That would be huge. We're not there yet, but I think sovereign wealth funds, central banks are showing the way. And that's why JP Morgan talked about the $6,000 gold by 2029. It could be before 2029. So as you can see, during this century, like against stocks, gold is outperformed, versus treasuries as well. Yes, after 2011, there was a big consolidation, just like the gold price did in cash, up until basically the beginning of last year when it actually took off. And you can see here that it's continued to go higher. So what this means is that yes, treasuries could rally in nominal terms, but in real terms versus gold. We've got a bull market in gold, a bear market in treasuries, and that's why the dollar is going to continue to weaken. And if treasury yields don't behave and go towards 5%, which is what Secretary Bessant said is kind of a line in the sand.
Mario Innecco highlights that, considering the current circumstances, the markets can be overly optimistic. Mario thinks the main news is in what China has to say, while investors wait for further information from leaders like US Treasury Secretary Bessant. He notes that the Chinese government's position might actually be more significant than trade headlines or statements made by American politicians in public. He perceives an effort to influence market sentiment, particularly with regard to US Treasury bonds. Behind all the commotion, Mario makes a compelling argument that the value of long-term US Treasuries is declining relative to gold, and this tendency is more clearer with time. Despite a short-term decline, gold is still outperforming in real terms, particularly when compared to government bonds. Mario uses a chart that depicts the price of gold in 10-year US Treasury notes to show how the value of gold has increased gradually in comparison to debt-based assets. He reminds us that bonds, which were formerly thought to be safe, are no longer dependable in the current economic climate, and cash itself is basically simply a short-term loan instrument. He also challenges the conventional wisdom of keeping a sizable amount of wealth in bonds, speculating that as institutions and central banks adjust to a shifting environment, a new portfolio model would develop, possibly 40% stocks, 20% bonds, and 20% gold. This trend is already underway, with central banks and sovereign wealth funds favoring gold over US Treasuries. This tendency is shown in JP Morgan's audacious prediction of $6,000 gold. And as always, happy investing.